June 2011, the first major crash, about 93%. Welcome to the original horror show. Back in June 2011, Bitcoin plunged from about $32 to nearly $2. The culprit? A spectacularly disastrous hack of Mt. Gox. Yes, the platform that once handled most of the world's Bitcoin trading. Picture it, hackers breezing into Mt. Gox, lifting tens of thousands of BTC from hundreds of accounts. They then dumped it on the market, which triggered mass panic selling. It wasn't just a security failure. Mt. Gox had gaping protocol issues and zero paranoia about its own infrastructure. Naturally, the market tumbled. There's more, but before we continue, smash that like button and subscribe because you don't want to miss out. Let's continue. To make matters more entertaining, the attackers apparently exploited transaction malleability, a weird bug in Bitcoin's architecture. By tweaking transaction IDs, they convinced Mt. Gox's system that withdrawals never happened, even though they absolutely did. Then they requested the funds again. Rinse, repeat. Not exactly a textbook hold and accumulate strategy. But here's the weirdly optimistic part. The market actually recovered. Slowly, but it recovered. Investors shrugged, dusted themselves off, and learned a hard lesson. If your exchange security sucks, you're essentially playing with fire and cheap matches. Fast forward to today, and the legacy of that crash still resonates. Mt. Gox's disaster exposed the fundamental need for secure trading platforms, better operational oversight, and airtight infrastructure. If you're not vetting where you're trading, you're gambling, not investing.
April 2013, Mt. Gox withdrawal halt had 83%. All right, buckle up. Let me take you back to April 2013, when Bitcoin had a meltdown so epic it could have had its own movie. It dropped from about $260 down to just $45, all because the same Mt. Gox decided to play now you see withdrawals, now you don't. They literally pulled the plug on withdrawals, sending shockwaves through the entire crypto world. So what went wrong? Well, for starters, technical failures. Big ones. Mt. Gox's systems couldn't handle the surge and he froze. Suddenly people were staring at error messages instead of cashing out. Naturally, panic set in, and when everybody's screaming sell, 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 that's what happens. Bitcoin spilled like a cup of coffee in an overly energetic coding class. And let's not forget, this was the wild, wild west of crypto. Exchanges were about as regulated as your sketchy neighbor's basement startup. No real oversight, no proper safeguards, just pure, unfiltered chaos. That magnified investor anxiety like crazy. But here's the kicker. After the volcano erupted, the ash settled. Bitcoin didn't collapse forever. Prices stabilized somewhere in the $70 to $100 range, which was a huge deal at the time. That dip recovery dance taught everyone a critical lesson. Without reliable exchanges, market confidence crumbles faster than glass on concrete. Fast forward to today, and guess what? The issue is still relevant. Security, scalability, and trustworthy infrastructure are more critical than ever. As your DeFi analyst, yes, I do this for fun, I'll tell you this. If you're trading on an exchange that feels sketchier than a 90s dial-up modem, you might as well be handing your private keys to a clown.
December 2013, China bans Bitcoin, around 50%. All right, folks, let's talk about a classic crypto drama. Back in late 2013, China banned its banks and financial institutions from touching Bitcoin. The price didn't take a leisurely stroll, it nosedived straight from around $1,150 to about $600. Ouch. So why did that happen? Well, China suddenly realized that Bitcoin wasn't just a wild toy for gamblers. It could challenge the financial system. Regulators got spooked, institutions scrambled, uncertainty crept in, and investors started hitting the panic button. Because when big players are unsure, retail freaks out too. Add to that the fact that exchanges at the time weren't exactly Fort Knox. Without solid transparency or regulation, shakes like this send shockwaves that ripple through the entire ecosystem. So yes, volatility went through the roof. But here's where things get interesting. This crash taught the whole world a geopolitical lesson no one saw coming. Suddenly, governments weren't just bystanders, they were key players. Regulations could tank prices, manipulate sentiment, and basically flex their muscles on the crypto market. Pass forward to today, and guess what? That lesson still matters. We saw echoes of it during more recent regulatory shakeups, whether it's US lawmakers debating stablecoin frameworks or Asian regulators tightening crypto policies. Geopolitics remains a high-stakes game in crypto. From a DeFi analyst vantage point, here's what really matters. You need to hedge for policy risk, not just market risk. Don't put all your eggs in crypto's borderless myth. Use platforms with strong compliance, decentralize your exposure, and always expect the unexpected. Because when governments realize crypto's potential and their fear, things can get wild very quickly. So yeah, that China moment wasn't just a crash, it was a geopolitical mic drop. And we're still hearing the echo.
February 2014, Mt. Gox Bankruptcy, 36%. Let's rewind to one of crypto's most iconic mess-ups, and your guess is as good as mine, the Mt. Gox disaster. Yes, the exchange that somehow managed to misplace 850,000 BTC. That's not losing your keys under the couch, that's losing the entire couch, the living room, and half the house. Naturally, Bitcoin tanked from $850 to about $550 because when the biggest exchange at the time collapses, the market doesn't exactly throw a party. The causes? Oh, where do we start? Exchange mismanagement was practically a sport. Zero transparency, questionable leadership, outdated security practices. Basically, Mt. Gox was the FTX of its generation, but with fewer tweets and more chaos. And once the news hit, investor panic kicked in at full speed. People rushed to withdraw funds the same way everyone rushes to delete tweets after a bad take. Now fast forward to today, and we're still learning from that fiasco. Just look at 2022, 2023. FTX imploded, BlockFi collapsed, Celsius melted down, proving once again that centralized exchanges can be the financial equivalent of trusting your money to a friend who's really good with investments. Spoiler, they're not. But to be fair, some good came out of the Mt. Gox catastrophe. It forced the industry to grow up. Suddenly, everyone cared about secure wallets. Hardware wallets, multi-sig, self-custody, the works. The phrase, not your keys, not your coins, went from cute slogan to mandatory survival rule. Exchanges started implementing better security, proof of reserves became mainstream discussion, and users learned to diversify where they store assets. The big takeaway? Trust is earned, not assumed. If 850,000 missing bitcoins doesn't convince you to take security seriously, nothing will. In DeFi, the safest wallet is usually the one you control, not the one managed by a guy named Mark running the world's largest exchange from his apartment.
January 2015, extended bear market, 50%. All right, let's talk about one of Bitcoin's underrated but beautifully chaotic dips. The slide from 315 down to around 150. It wasn't a Hollywood-style crash like Mt. Gox or FTX, but trust me, this one had enough drama to qualify for a Netflix mini-series. At the time, the market was still recovering from previous shocks, and investor confidence was basically hanging by a thread. Think of it like crypto's awkward teenage years, big dreams, bad decisions, and absolutely no idea how to handle public pressure. Weak confidence meant every small piece of bad news felt like a doomsday prophecy. Then, enter regulatory pressure because, of course, government agencies around the world suddenly woke up and said, wait, people are actually using this stuff? Combine that with early rumors about tighter controls and possible bans, and boom, investors started selling like they were allergic to profit. Meanwhile, adoption was painfully slow. Infrastructure back then made the blockchain look like dial-up internet. Wallets were clunky, exchanges were questionable, and buying Bitcoin sometimes felt like applying for a visa. So, naturally, fewer people were participating, which only increased volatility and extended the downturn. Back then, the downturn forced the industry to mature. It pushed developers to improve wallets, exchanges to strengthen security, and institutions to take blockchain seriously. In hindsight, that 315 to 150 drop wasn't a disaster. It was Bitcoin's awkward growth spurt. Painful, embarrassing, but absolutely necessary for the beast it would eventually become.
September 2017, ICO ban in China. The moment China decided to ban ICOs, it sent Bitcoin tumbling from around $5,000 down to about $3,300. If you've been in crypto long enough, you already know when China sneezes, the market catches pneumonia. At the time, the ban sparked global headlines because, of course, the media loves a good Bitcoin is dead story. Every outlet jumped in like crypto is over, pack it up everyone. And retail investors, bless their jittery hearts, responded with panic selling as if Bitcoin had personally offended them. This stacked beautifully with regulatory crackdowns, creating a cocktail of short-term volatility that made prices whip around like a meme stock on earnings day. But here's the fun part. While the market was having a meltdown, analysts watched the data and realized something hilarious. The fundamentals hadn't changed at all. The blockchain didn't slow down, global user adoption didn't reverse, and miners didn't suddenly quit and become farmers. In fact, very on brand for Bitcoin, it rebounded almost immediately, refusing to stay down like a stubborn toddler. Even today, when regulatory FUD hits, whether it's the SEC going after exchanges or new tax proposals, the market dips, panics, and then quietly recovers again. And yes, despite that 5K to 3.3K drop, Bitcoin rocketed to $20,000 by December of the same year, proving once again that Bitcoin's resilience is less of a feature and more of a personality trait. It dies, resurrects, and moonshots all before lunch.
January 2018, post-all-time high correction. The massive slide from its shiny $20,000 peak down to around $6,800. Ah, yes, the 2018 crash. The moment when the entire crypto market collectively realized maybe buying the top because of a cousin's WhatsApp signal wasn't the best plan. This drop was fueled by a perfect storm of FOMO-driven buying, wild speculative mania, and regulatory warning shots that spooked investors faster than a sudden SEC press release today. It was the era when everyone thought they were geniuses because a meme coin went up 40% overnight. Spoiler, the market disagreed. But here's where the story gets interesting. We're seeing the same behavioral patterns play out again. Retail still chases tops, institutions still pretend they hate crypto until prices rise, regulators still show up uninvited like NPCs in a boss fight, yet somehow Bitcoin continues doing what Bitcoin does best, humbling people. What the 2018 crash taught investors is painfully relevant today. Short-term hype is a trap. The lesson? Long-term conviction beats emotional trading every time. Or in simpler terms, zoom out, touch grass, and stop treating Bitcoin like a scratch card.
March 2020, COVID-19 pandemic crash, 50%. This was the time when the world collectively lost its mind, and Bitcoin decided to join the chaos. At the time, BTC was chilling around $9,100, and then boom, global panic hit harder than a surprise Binance announcement. Within days, prices plunged to about $4,000, marking one of the fastest 50% drops in Bitcoin's history. And honestly, you couldn't blame the market. Every asset class was melting, stocks crashed, oil went negative, investors were liquidating so fast it looked like everyone suddenly remembered they had rent due. Bitcoin got caught in a crossfire as mass liquidations, broken leverage dreams, and good old-fashioned macroeconomic fear sent the market spiraling. Now, add today's irony. The same institutions that once called Bitcoin a speculative toy ran straight to it once the money printer went burr. As governments rolled out trillions in stimulus, investors needed a hedge that couldn't be inflated into oblivion. Enter Bitcoin, the digital asset that refuses to die, much like those influencers promising 100x altcoin gems. Every time the Fed coughs, Bitcoin shakes. Every time inflation spikes, institutions suddenly remember Bitcoin exists. Just this year, we've seen renewed volatility after global recession fears, and yet institutional inflows into Bitcoin ETFs continue rising. BlackRock alone pulled billions in fresh inflows after the latest dip, because apparently fear is temporary, but Bitcoin conviction is forever. What this crash taught us still holds true. Macro eats memes, liquidity drives markets, and when uncertainty hits, leverage goes boom. But Bitcoin, it rebounds faster than airdrop farmers switching chains.
May 2021, Tesla and China ban. This month, Bitcoin holders aged 10 years in 2 weeks. 1 minute, BTC was flexing near $58,000, and the next, boom, it cratered to $30,000 faster than you can say Elon tweeted again. The chaos truly began when Tesla abruptly halted Bitcoin payments, supposedly because Bitcoin mining was melting the ice caps or something equally dramatic. Then, as if the market wasn't emotional enough, China dropped a full mining ban, forcing half the network to pack their GPUs and go home. And in classic crypto fashion, X, amplified the panic until it felt like the blockchain apocalypse had arrived. The result? A clean 50% drop that had new investors questioning their life choices and veterans nodding like, yep, standard Tuesday. But here's where it gets funny. For all the environmental outrage, the crackdown triggered one of the biggest transformations in Bitcoin's history. Mining operations relocated, renewable mining surged, and suddenly everyone was talking about sustainable Bitcoin like it was a Whole Foods product. Fast forward to 2025, and BTC mining is now more renewable than most countries' energy grids. The US and Kazakhstan absorbed much of China's lost hash power, and companies like Marathon and Riot now publish ESG reports thicker than most altcoin white papers. Meanwhile, Elon, he quietly refollowed a few Bitcoin influencers and moved on to meme coins. Even today, whenever regulatory FUD rattles the market, whether it's a European mining proposal or chatter around US energy audits, analysts still reference this 2021 crash as the turning point that made Bitcoin more resilient, more decentralized, and yes, more environmentally aware.
November 2022, the month the crypto world collectively facepalmed. Bitcoin was sitting pretty around $21,000, and then FTX went bankrupt, setting BTC tumbling to roughly $10,000. The culprits? Classic institutional mismanagement, zero transparency, and good old market panic. FTX somehow managed to convince millions to trust a platform that couldn't balance its books. Investors were liquidating positions left and right, creating a domino effect that dragged the entire market down. Panic was so infectious that even seasoned traders checked their wallets twice, muttering, "This cannot be real. Again?" But every disaster teaches lessons, and FTX was no exception. Regulators finally sharpened their pencils and started scrutinizing exchanges like overprotective parents at a party. Suddenly, proof of reserves, internal audits, and cybersecurity standards were not optional, they were survival tools. Even DeFi platforms had to step up their game, because if a centralized giant could fail so spectacularly, the decentralized space wasn't immune either. Fast forward to today, and the ripple effects are clear. Exchanges now publish transparency reports, many hold insurance funds, and institutional investors perform due diligence like detectives on a Netflix crime drama. Meanwhile, Bitcoin shrugged, bounced back, and continues marching onward, reminding everyone that it doesn't care who runs an exchange poorly. So what's the takeaway? Exchanges can implode spectacularly, but Bitcoin survives. Always vet the platforms you use, check their security measures, and don't let FOMO override common sense. Panic is contagious, but disciplined strategy and risk awareness are the real vaccines. Remember, if your portfolio can't survive a headline, maybe it's time to rethink your crypto life. What Bitcoin crash hit you the most? Do you think there are more Bitcoin crashes ahead? Share your experience in the comment section, and if this video resonates with you, hit the card above. I have something interesting for you. This is Blockchain Money.